Welcome to this new episode of your next trade called today a record month. So in November, stocks were up 10%, S&P roughly 10%, Nasdaq 11%, bonds were up, everything was up, gold unless you were long commodities and WTI. So as you remember, a month ago, I bought back my shorts that I had on the S&P that I had in Europe on the stocks 50. I was a bit disappointed, but because it's very hard to get the bottom. But I've been lucky enough to not be short over the last month. So what is quite funny, if you go on Twitter now, you see the macro guys telling you, I told you about it. You'll see the breakout people saying, this year has been an incredible year that you'll be making a ton of money, and they are back of, showing their daily and intraday trades. So not that easy, to be honest. Big short that was squeezed out. This is something that we flagged both in here and in the community. So this market is more and more driven by options. And when the market, touched the 4,200, we thought, it was a good level, at least to close your shorts. Why? The reason was pretty obvious. There was tons of call options, call spreads that were expiring in November, the 4450, 4500 that were bought. And after that, when the market started to rally, those options moved to 4500 to 4600. So now we are at 4600 on the cash for the S&P. And I think it's going to be hard to go much higher, at least in the next 10 to 15 days. If you look at the seasonality of the S&P at the start of December, it's pretty hard. We got the blackout period from the Fed, so not much to happen before the FOMC meeting, which will be in 10 days. But really, the market has been enjoying the yields coming down, the expected inflation coming down. So we have the inflation, the CPI, the PCE, where the numbers came lower. That is true in the US, that is true in Europe. So now there's a feel of, inflation is past, and as well that the economy could go through a soft landing. So this is what the market is pricing. You are at 4,600 on the S&P. Having said that, in terms of positioning, as we're going to see for the S&P through the options chain, the option market is telling you that there is not much positioning on the upside now. So it's going to be much harder for the market to go higher. There is a lot of position between 4,500 and 4,600. So next few days are going to be interesting. As always, let's start with the week-to-date asset performances, where if we look at the overall market, S&P was up roughly 1%. As you can see, the laggards, which was the Russell 2000, has been doing much better over the week. So over the last 2 weeks, and especially yesterday, should I say on Friday, anything that was the most shorted stocks, the tech that are not making money, have been on a tear. So there has been a huge divergence on Friday, huge rotation between the losers of the past that were really strong and the winners that have been struggling. If you look at Europe has been strong as well. So almost any equity market has been strong except China. So Chinese market still struggling. Dollar flattish on the week, but we start to see some weakness versus the dollar, the yen. Sorry, so the yen is now trading at 147. So this is a huge position. People have been very, very short. The yen, it went to 152. There was rumors that the Bank of Japan will be doing some intervention. So that's the one I'm watching. I do have a position in that space. Gold very strong. So Bitcoin / gold at 2050 and above, very, very strong, close to the all-time high at 2080. So everyone is watching this level. WTI weak despite the OPEC meeting saying that they would be cutting another 1 million barrels. So we are trading around 75, 76. But what is happening is actually the US have been upping their production by 4 million barrels over the last 2 to 3 years. So you do have a lot of production coming from the US, and OPEC is not cutting enough to balance this huge supply. Let's look at the week-to-date industry performance. And this one is really interesting because if you look at the S&P is here. So what you can see, you have tons of outperformers versus the S&P on the week. And the reason is pretty clear. So the big winners of the past, the FANG, the Facebook, the Meta stock, the Meta stock, the Apple, the Nvidia have been struggling on the week. So that means all the other 490 stocks have been pretty strong. And that gives you this picture where the regional banking up 7% on the week, that you get the cloud, you get anything that is not those big names that have been doing well. And you can see that as well, the semiconductors that have been very strong until, a couple of months ago. Actually, if you look on the relative basis, they are not outperforming the market recently. So looking at the sector's performance, so the telco down on the week 1.5%, real estate really strong. That is explained mostly by the US 10 years, the yields and anything that is yield coming down. So that is helping the whole space. Materials, that's something that you should be watching. There have been up almost every day for the last 10 sessions. So overall, the picture is pretty strong, but there is rotation in the market. And as I said, the past winners have been struggling recently. What about the rates? We're going to be looking at the 10 years, the 5 years, the 2 years. So let's look at the 10 years in the US, 4.2%. So you remember at the start of the summer, we were at 420, 430. We had this massive move where we moved to 5%, and there was a very strong correlation. So if you look at the past Euronext trade episodes, there was really tick by tick when the bonds were coming lower. That was the same for the S&P. So the correlation was 1. And as we flagged at the start of October, we started to see a divergence or the end of this strong correlation between the two. Bonds went down, yields went down massively from 5 to 4.2. So we went from 350 to 5%. Now we're back to 420 on the 10 year. So we are back in between the two. So in terms of risk reward, not that great. We overshoot in terms of yields on the way up. So many people try to reach the bottom in bonds and through the TLTs, through the futures. They didn't manage to do it. Now we are back to square one, and that's the same with the S&P, where we are back to where we were 3 or 4 months ago at 4,600. 10 versus the 2, still inverted. So for those of you who believe that inversion is a good sign of or a good leading indicator for economic slowdown and recession, this is still happening. So what about the Fed fund rate? So that is for the FOMC, for the Fed expectations going forward. So for the time being, we are at 5.33%. I'm interested into two things. So what is the market pricing now? So if you look at June, we are looking at 483. So that's a differential of 0.5, which gives you 2 times 25 bips, 2.2 times 0.25%. So before June 2024, the market is expecting now the Fed to be cutting rates by 0.5%. Now, if you look at December, you're going to have another 60 bips. So overall, for the year of 2024, now the market is expecting 4.5 25 bips cut, like 1.1%. So that is quite massive. In other words, the market is now pricing the Fed to be quite dovish, and that's an understatement, cutting rates. And if you compare what we had from a month ago, so that was at the start of November when the market was talking about the S&P at 4,200 versus now, you see the differential between this 515 and 483. So we had a differential of 30 bips, 0.3%, and here we got a differential of 50 bips. So overall, between the start of November and the end of November, market is now pricing the Fed to be cutting in 2024 by 50 bips more than it was a month ago. So that's very aggressive. That is the pricing now. That is due to the CPI coming lower. That is true in the US. That is true in Europe. But we are expecting the different central banks, we are talking mostly the ECB and the Fed, to be starting to be cutting rates in 2024. So are we back to the ZIRP? Are we back to quantitative easing and very accommodative central banks? This is what the market is pricing, and that gives you this hoo-ha-ha phase where stocks are going up, bonds are moving big time. What about the VIX? when market is in this hoo-ha phase, you have the VIX coming down much lower. So now we are at 12.6%. You remember not so long ago, that was at the end of October, we were at 20% when we got the Palestine, Israel, and all of this. So if you think about where that gives you the chart, 12% is pretty low. That doesn't mean that it could go lower. And I think what is interesting is now to something that I explained well in the 4x4 video series that I explained, over the years, is the differential between realized volatility and implied volatility. So VIX here, you got a 30 days implied volatility for the S&P. And recently, the realized volatility has been plummeting. So that's something we'll be discussing later, but that's the differential between realized and implied volatility. So now I'm going to go into the charts, starting with the S&P. So the S&P, the 4200, this is the level that we explained at the end of October. We overshoot on the way down. Unfortunately, I bought my short a bit earlier, and since then we have been recovering quite aggressively. So we are almost back to the 4620, 4650 that we had recently. As I said, I think the 4600 is a big level, at least for the time being. If you look at the options, at the where the open interest for the expiry that we have in 2 weeks. So what happens this year is we have a quadruple reaching on Friday, the 15th of December. So that's pretty early. And that tells you most market participants will be reducing their exposure, closing their books around that time. So that gives us only 2 weeks. If you look at seasonality of the market, normally not much is happening in the first 10 days of December, and then the market starts to move. And if you think about the two drivers, we get the Fed, that will be in 10 days, and then you get the OPEX option expiry in 2 weeks. So my view is not much is going to happen, but having said that, the market has been very strong. If you look at the Nasdaq, we have been consolidating a bit. We met new highs, but the interesting one is the Russell and the Nasdaq versus the Russell. So as I said, yesterday was a really big day in terms of rotation, where the Russell was up big time, 3%. So as you can see, when the Nasdaq was up 0.2%. So the divergence was 2.5 to 3% on the day. So that is pretty big. A huge rotation that happens very often, at the end of a move. So that's something we need to look at. And that's the same with the Meta, the FANG versus the overall market. So that explains a lot why, if you look at the S&P is up 0.8%. So that is normally the average up market. That is something that I flag in the community on after Thanksgiving week. You will have the market 0.5 to 1%. So we are close to the normal level. But what happens is actually the FANG of this world have been struggling versus the overall market. So is it the start of a big rotation? You start to see people that are flagging the fact that maybe those big winners, this NVIDIA, the FANG, the semiconductors will be struggling in 2024. And that could be some pain for the market, because the market is very long those names. And we are talking the hedge funds, they have huge positions, mutual funds, everyone is long those names. So really, I think this is going to be the one to look at least in the early 2024. CL1 for WTI, as I said, I didn't have that much of a view, bullish or bearish, but really struggling despite the noise in the Middle East. Copper, pretty strong. So that's a good sign if you think about the economy doing better. But gold, really, this is the one to watch. So as I mentioned, everyone's got the same chart. I didn't put it here, but this is the level to be watching. We are talking 2075, 2080 for a potential breakout. So I guess too many people are looking at it. If someone that is not trading that much gold is the one, that is a sign that maybe it's a crowded trade. Euro dollar 109. I've been struggling at the end of the week. Dollar yen, I think this is the one. As I mentioned, I have a position in this one. I think it could go to 145 first. I've been short since 151, increased the position. So this one at least is working. JP Morgan, interesting chart. I'll be looking at this trend, if it's going to be testing again. We are testing the recent highs. So those are the names that you should be doing. Look a bit at Europe through the DAX. So DAX very, very strong, close to the all-time high. Same with the Stocks 600 and the Stocks 50. So I started at least to hedge my longs versus the Stocks 600 and the Stocks 50, and doing a bit of a short on both the S&P through. I've done some put spreads. March we are with a 10 to 12% downside, offering something like 12 to 13 times risk reward. So what about we just look at what happened in the past? So we're going to carry on with this week. So this week we had the PCE, which was in line. We had the end of the month, so we had a bit of a funny move here on the end of the month. That was here where the market went from 45.50 to 45.75. Powell, that was yesterday, so telling us, it's still data dependent, blah, 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 blah. But the market is pricing, as I said, a more and more dovish Fed, and more dovish ECB. But what is interesting is two things. Is this thing here, the short put. So this is from Nomura explaining what has been the strategy again in 2023, which is about selling volatility and selling straddle. And the one that is interesting, selling the daily 25 put gives you on the 10 days a 73 Sharpe ratio. If you think about it, this is just a crazy number. So it has been again and again about selling volatility. So implied volatility has been coming down massively, and the realized volatility, as you can see here, is now on the S&P below 5%. So there's still a bit of a gap between realized volatility and implied volatility, which is always the case, where implied volatility most of the time will be above the realized volatility. But so far, as we don't see that many hedging on the tail calls or put out of the money, that explains why the market is just going higher and higher. Why? Because as volatility is coming lower, you have more market participants that could increase their gross exposure and exposure. If you like to do a bit of macro, I think it's still interesting, it's still important, despite the squeezed manufacturing PMIs. So they came out a bit higher for the global, but overall this is the same picture. So everyone is scratching their head where we had the PMI, the ISM manufacturing on Friday. The ISM manufacturing was at 46% something. And that normally translates into an economy, a GDP down by 0.7%. So why the economy is doing so well? If you look at the details of the GDP, you'll see obviously that there is inflation, but you will see as well that the government is very, very active and putting a lot of money into the system. And you'll see that the deficit of in the US are running by 5 to 10%. So as long as you get 5 to 10% deficit, it's hard for the economy to go into recession. But, like any emerging market, like if you remember, some years ago, if you look at Greece, if you look at some, countries in Europe that the markets didn't like, that they were using too much of a deficit, maybe one day it's going to be the same for the US. But really, the overall economy, and that's something I've been struggling. I thought that the US consumer will be really start to fade in October. So far, it's kind of okay, but I don't see how it can last with the macro data being not that great, and especially with the Chinese numbers not great. So we look at a lot of the past. So what could happen in the near future? So looking at the catalyst, we get the ISM PMIs on Tuesday, and we get the non-farm payrolls on Friday. So those are the two big numbers in terms of macro. We get the Bank of Canada rate decision on Wednesday, but it's expected to not do much, so to be same. We get the Fed blackout period, so not much to expect from Powell and his friends. So we won't see many headlines from the Fed. We won't see any headlines. We might see some headlines coming from Wall Street Journal and some other journalists about what could be the policy going forward. But In terms of earnings, not many earnings. We do have like some interesting names, at least to trade for the Lululemon, for the Dollar General. So PMI services, as I said, the seasonality over the next 10 days, the first 10 days of December, it's not that great, and you should, most of the time the back of December is much better when the market starts to squeeze a bit. Weekly straddle as always. So what is the implied volatility for the week? 1.2%. So that is pretty low still, and that is the same as the VIX. That is the same as the realized volatility. So NFP day on Friday. Recently, the moves have been pretty good because the market, lacked that the numbers didn't overshoot and beat too much. So what you don't want to see these days is a very good NFP number, because good will be bad and bad will be good. So for the equity market, you like to see number in line or a bit lower. And finally, I want to talk, as always, and something that I flagged again 2 weeks ago, the market is, at least for stocks, is driven 60 to 80% by options. So if you don't understand options, if you don't understand the positioning of options, you will be really struggling to be making money. And what has been happening, so if you look at the S&P option chain, if you look at the Friday, just to give you an example, you can go on the CBOE website and trying to find out where are the open interest. And you will see that so far, most of them were 4,500 to 4,600. So as long as you don't have a change, and those changes could happen soon, the market has been pinned between those two. We'll see in the near future if it could change. So this is it for me today. I didn't do much videos over the last couple of weeks because I had to go to Paris. That was Thanksgiving, but and I think I'm going to do one next week and maybe a week after. So if you have questions, please send me an email. Join us on the trading community on Discord. This is for free. And you can obviously subscribe to the video series. There is a 25% discount until the 31st of December. And that will be for the 2 months and the 12 months. This is it for me today. I hope to see you next week. Bye-bye.